Now is ArkenYield founder and CEO Connor Romanoff. Connor, let's start with a quick overview. What is the business of ArkenYield?
Yeah, so essentially what we do is we offer delta neutral yield for big stablecoin holders. So kind of like you would see with, traditional, yield accounts that like banks offer. We're offering that for, institutions who hold stablecoins. So, it allows them to actually put them to work because right now there's very limited options for those institutions to earn yield on stables. There's exchanges that offer it, and then there's the more difficult to get to DeFi lending protocols. But for the average, fintech or neobank that's starting to offer stable, deposits for their clients, they don't really have, a good yield program built out yet. So that's kind of where we come in. You can think of it as we're building out their high interest savings account, so to speak.
Okay. The Genius app prevents the charging of interest on stable coins or the earning of interest. Does this somehow sidestep that limitation, or does it contradict? Is there any gray zone in there is what I'm wondering, regulatory side?
Yeah. So with the Genius Act, they're preventing the issuers of the stablecoins from, offering users of that stablecoin a yield. But what we do isn't covered under that because we're taking existing stables like USDC or USDT and then market making with those to earn our yield. So it's not covered by the act and it's compliant.
Okay. What is the risk profile of a company that wants to trade in stablecoin using your platform?
Yeah, so that's our main appeal here is that, we take the lowest risk possible. So what we're faced with in terms of risk right now would be, the actual DPEG risk of the stablecoins themselves. So you could think of that as like a DPEG or asset risk. And then also there is a protocol or smart contract risk with some of the protocols that we're using, like Uniswap or some of the other decentralized exchanges that we work on. But, since we're not doing more risky strategies, like for example, with DeFi lending, whereas like that's the current place that people are going to earn yields, that introduces additional risks like bad debt or oracle risk when there's liquidation. So, by focusing on market making specifically just on stablecoin pairs, we're offering the lowest risk profile for our partners.
What is the total daily trading volume dollar-wise in stablecoin currently?
Daily would be hard to give you that, but yearly I know it's around 27 trillion as of last year, and it's increasing 60% year over year. So I think what we're seeing is the merging of traditional finance and decentralized finance coming together, and it's our thesis that it's inevitably going to have to merge. I think everyone's going to end up transacting in stablecoins to some capacity, or even if they're not directly transacting in them, the accounts that they hold with banks or financial institutions, those rails are going to be taken over by stablecoins. So, we anticipate stablecoins to make up the bulk of the global economy at some point.
I see. And so I'm assuming that the trading activity itself in stablecoin is algorithmic, essentially?
Yeah. So, we have our own proprietary algorithm when it comes to market making. But yeah, it depends on kind of the activity that you're working on. But for example, our kind of flagship is concentrated liquidity market making on two, stablecoin pairs. So we'll have like USDC, USDT. And what we're doing is basically taking the deposits, using those funds to bridge people back and forth of those two assets and then taking a fee. So, it's some very low risk, right? Because you don't have the risk of impairment loss like you would with, traditional Forex trading. It's like the first time in history where you can have like two US denominated currencies trading at such a high volume against each other.
Right. So I guess the volatility in the pricing of stable coins pegged to USD has got to be very slight, like less than a penny, I would think.
That's exactly it. So the spreads are very, very thin, but the volumes are immense. And actually our yield increases with volatility. So if you see Bitcoin trading at all-time highs or like local lows, that's actually when our yields increase. So, we make more when there's more trading volume to be satisfied through our market making.
Okay. So the product that ArkenYield offers to institutional holders of stablecoin is yield on stablecoin holdings without putting the stablecoin itself at risk.
Exactly, or just the very minimal risks that I mentioned before. But we also offer analytics, we offer treasury management, and we even are getting into some OTC stuff as well for larger singular transactions too. So, it's kind of like the whole stack of stablecoin yield.
Okay.
And management.
So if I have $1 billion in stablecoin, I'm going to deposit that in your account, in your custodialship, and you're going to put that to work in the marketplace, and anytime I want, I can withdraw that $1 billion, including the yield, or is it some derivative of that?
Yeah, so we have it's fully liquid strategies that we're involved in. So, since we're market making on stablecoin pairs, it also makes it very easy for us to withdraw for a client because, we're not like stuck in some volatile asset that might be underwater at a given time. So yeah, as soon as the client wishes, they can withdraw. Also, the yield is added to their account daily. So it's like as soon as we earn it, it's added into their wallet. In terms of custody, we actually have a third-party custody provider, which allows the actual bank or fintech or client of ours to hold custody of the funds the entire time. So, we don't have the ability to withdraw those funds from a client's account. It's their wallet and their private keys. We're merely like the strategy partner where we suggest the transactions and they pre-approve those. So we're, I guess, dictating how they would trade and, doing the trading, but we never actually have access to the funds themselves, which is great for, a bank because it cuts down on the amount of regulatory and compliance needed to partner with us.
Right. So there's zero risk of something like what happened with MF Global, where they used segregated funds to cover liabilities in another account, which resulted in losses for the holders of those assets. You're not in possession of the assets per se. You're just operating the trading of those assets on behalf of the client, and it stays in their control at all times.
Exactly. So it's like the same ways that where if you have your own crypto wallet and you go and interface with a decentralized application, that application is not getting access to your wallet or the funds within it, but it will suggest transactions or activities that you can use with your wallet. So we're doing the same thing, just at a much larger scale, and taking these funds and directing them to different DeFi apps or DEXs.
Sure. And what is the expected performance of funds in your system? What can I expect back on my $1 billion every year if I let you trade that?
Yeah, so currently what we're doing is around 22 to 23% APY. That's as of this year, what we're on target to do. So around 2 point something percent each month. But again, as more capital flows into this, there will be compression of the yields. But, that's more of a long-term kind of risk. In the mid to short term, we actually see yields increasing because you have a lot more adoption of stable coins. You have a lot more networks competing for stables to be on their blockchains. So actually in the medium term, we anticipate yields to rise, but we can pretty reliably get into the low 20s as a yield, which is obviously fantastic. And not only is it great for people who already, hold stable coins, but it's quite the incentive for people who hold fiat and, are tired of just the basic T-bill returns, who might want to have something a bit more impressive as a return profile.
Sure. What is the risk to a position of stablecoin if, let's say, just for example, some unforeseen black swan, as they call them, looms into sight and takes, say, Bitcoin down by 50% or something? I know that USDT and stablecoins are not directly correlated to Bitcoin per se, but is that going to have an effect on any aspect of this ecosystem that you've created?
So it could with traditional DeFi lending because they allow assets like Bitcoin or Ethereum to be used as collateral. So that's like where a lot of the yield is coming right now, is from that. It's also from trading fees on these different perps platforms that are, offering a yield. We stay away from that. So just by doing market making on stablecoin pairs, that means we're not exposed to anything that has to do with other cryptocurrency assets. It's only what we really put into the pair is what we're exposed to. So let's say USDC or USDT, and then if there were some kind of black swan, I won't say with Bitcoin because we're not touching that, but let's say a stablecoin depegs, that would be the worst risk that we could face. But again, that's also why we diversify the amount of stablecoins and networks that we're working on. So, it's not just USDC, USDT. So if Tether depegged, there would be an issue there. We're touching all the different stables and we look at which ones have the most reputable history, and then we allocate more towards those and less towards the newer stable coins that might be, a bit less trusted or have a bit less of a backing behind them. So, we're making those determinations ourselves to make sure that we're well diversified in case of any of those events.
Right. So just as a sort of case study, let's say that I'm a client, I give you $1 billion, you trade it, you earn 20% for the year. How much of that do I get? How much of that do you keep?
Yeah, so that depends on the client and the amount of funds put in, but we do have a pretty standard fee schedule. So we're taking it's around 1 in 10 fund structure. So kind of similar to what you would have, at a traditional fund. And then we also have a high watermark of 5%.
Okay. So translate that for this poor, incompetent mathematician. What does that mean to you for your annual piece of that?
Yeah. So let's say that, the yield ends up being 20% for the year, so we would take 1% from there. And then we would also take 10% of the performance, which would be another 2%. So of the 20, we would take 3. So you would end up with 17%. We would end up with 3%.
Okay. So I guess it's completely volumetrically correlated. The more stablecoin you trade, the higher is your annual revenue.
Yes, our revenue does increase with the assets under management. We only do well when our clients do well. So that's kind of how it's structured. And with the high watermark of 5%, that means we don't take any fees if we're not at least yielding 5%. So it's kind of a no-brainer for CFOs who might be looking at, like I said, T-bills, which are yielding 4%, and they're thinking, hey, I could get at least 5% with these guys. And the risk is very marginal with the strategies that we're doing.
Sure. So for your company, though, if risk compression is a threat on the horizon, then how does that affect your high watermark? Does that obviously going to have a negative impact on your earning?
Yes. So yield compression is like the biggest kind of hurdle that we have to get over. So that's something that we're looking into. It's not really a concern right now. It's especially sub 1 billion AUM. That's not something that we're going to have to worry about too much. But yes, if we, obviously we plan to grow and become more successful, at a certain point, there are going to be compressions. But I feel at that point, there'll be other protocols and other strategies that we might be able to expand to. So, we might not be doing pure market making on stablecoin pairs. We might look into some other things, maybe even traditional credit. If those things start moving over towards stables, we could get into that. Really, our goal is to become the top stablecoin yield providers, regardless of where the yield's coming from. So, we could offer, our flagship right now, which is market making, but maybe we look into credit, we look into some DeFi and make stuff. That's on the horizon for us as well to make sure that we're maintaining yields in the long term.
Mm-hmm. Interesting. So the barriers to entry of a competitor, let's say a more deeply capitalized entity like JP Morgan sees what you're doing and says, hey, that's a great idea. Can they muscle in and muscle you out?
So it's already like that. So with market makers, we are competing against the other existing market makers. So competition is actually baked into what we do daily. So, there's always going to be people chasing the yields and trying to come after us. But, that's not something that they couldn't be doing today. I don't think those guys are touching stablecoin yields right now, but we do anticipate that to also be a factor in the compression, not only our capital or assets under management increasing, but competitors moving capital into the space to compete as well. But the way that we do it with concentrated liquidity market making, it means whoever has the best predictor of the spread for the stablecoin receives the lion's share of the fees. So that's kind of where our edge comes in, is that we've been doing this for longer. We have a lot more data. So it would be harder for, competitors to come in against us. And then also it'd be harder for them to justify to their clients, we're doing the same thing as ArkenYield, but we're earning, 5% less. Why wouldn't they just come with us? So kind of we see it as a winner takes all scenario, but as you know, in traditional finance, there's always competition with market makers.
Sure. All right. Connor, we'll leave it there for now. We'll come back to you in due course. Thanks for your time today.
Yeah, my pleasure. Thanks a lot.